We are so lucky to have the mad scientist of syndication real estate himself, Neal Bawa. Neal, you have taken just a short jump down in your portfolio, 700 million.
700 million.
It's a tough market, but 700 million and holding. And we want to ask you about today's market, how you're doing, and really just what everybody's saying right now here at the Best Ever Conference today. And we got to introduce Christion Sadler. He's the VP of Investor Relations for PREIShare. CRE Syndicate is sponsored by PREIShare as well as Family Office Insights. And let's get started. Let's jump in.
Yeah, let's jump right into it, Neal. I know that you spoke at the conference today. Usually we'll start the show off talking about what's happening in the news. But what's happening in the news is we're at Best Ever Conference. This is one of the largest syndicated real estate conferences in the country, I believe.
That is correct, yeah.
And I would love for you to start off by sharing just some tidbits of what you spoke on today.
So yesterday my presentation was on distress in banks, not distress in multifamily or in real estate, but distress in US banks. And the reason I did this presentation, I actually begged that I be allowed to, produce on this topic, was because I go to YouTube, and as you can imagine, my YouTube throws up a lot of real estate related stuff. And I see stuff like $1.4 trillion of loans coming due. Commercial real estate might kill banks. Money may not be available. Liquidity crunch coming and stuff like that. And I realized that YouTube creators have to use clickbait. And so I click on it, and then I watch a little bit more of it, and then oh, maybe that title was clickbaity. No, people are actually beginning to believe that because of the troubles of commercial real estate, because of the fact that properties have dropped in value, refinancing is hard, interest rates are high, that somehow this is going to affect the United States banking system in a way similar to 2008, which could lead to contagion, could lead to mass-scale bank failures, or worse, the Great Depression. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today, or click the link in the description below. And now, back to the content. And normally I sort of ignore this kind of stuff, but now I'm starting to hear it from people here and people at other conferences. And clearly, if you have 5,000 people producing YouTube videos in the same content, it becomes truth, even though it may be complete BS. And so I'm like, okay, maybe this stuff is true, right? Shouldn't I just delve into that? So I with the help of my amazing friend ChatGPT, I started gathering information on banks in the US. So my presentation, to sum it up, was there's 4,017 banks in the United States. 282 of them are in trouble because of commercial real estate. 50 are in serious trouble. Half of those will go out of business. Luckily, only one New York commercial bank or New York community bank is a big player, the size of Silicon Valley or Signature Bank or First Republic. So we have one bank that might fail, probably will be bought by Jamie Dimon because he buys banks for fun. And none of this is bad news for the US economy and such. It's not bad news for commercial real estate. It's not bad news for multifamily. It's just bad news for the investors of 50 banks. And I also learned that banks in the United States fail on a regular basis and no one cares. The FDIC comes in, they shut down the bank. 2 days later, the bank opens with a new name. And this has been going on for 100 years. So there's some truth to the fact that banks are going to be in distress and some of them will go out of business. There's absolutely zero truth to the fact that this leads to any kind of financial contagion or ridiculous liquidity crunch. If all 50 of those banks go out, we will now have lost 50 out of 4,016 banks. There's no monopolistic situation here at all. And I was trying to clarify that for people. And when I walked out of that room, people followed me out and said, I'm just so relieved to hear this, because all I hear on YouTube is the world is ending because of commercial real estate.
Right. And Neal, I mean, you're a data scientist, so a lot of people do look to you to understand these numbers because there's so much to understand. You've raised over 300 million in equity, so those people are obviously looking to you and saying, how do we weather this? How do we move forward in the current market climate? I would love to hear your take on it.
I think the first part of it is to convince yourself of what is reality. And I'll mention reality and then I'll mention where I think my brethren are mentally. The reality is today's actually a very good time to buy multifamily. It's massively better than buying multifamily 24 months ago. Because today you can buy the same exact property that you were buying for $36 million 24 months ago, you can buy it for 28. Now, in that time, that property's net operating income has gone up. Maybe not spectacularly up, rents are flat, but they go up a little bit. So in the last 2 years, maybe rents have gone up 1%, 2%, whatever it may be. Modest. But its income has gone up and its price has gone down 25%. If you ask Warren Buffett, is this a good deal compared to 2 years ago? He would say yes. In fact, every businessman, every tycoon would say, yeah, you're in a better position because you're buying the same income and you're paying 25% less, right? And of course, the point is, well, yeah, but my mortgage is higher. Yes, but mortgages change. Your purchase price never does. Right? So when people say the profit is not in the sale, it's in the buy, they're right. Well, your buying price is always going to be lower than it was 2 years ago. So you're in a better position. But your ability to refinance still exists, right? Your ability to benefit from any trend that we could see over the next 5 years where prices go up still exists. That is the reality of the situation today. That doesn't mean it's easy to get loans. That doesn't mean it's easy to make projects pencil. I find that projects are just as hard to pencil as they were 2 years ago. Nothing has improved in that regard. They're still hard because sellers are still as stubborn and obstinate as they were 2 years ago. Only 2 years ago, they wanted 36 million. Today, they want 28 million. In both cases, maybe they should have taken a few $1,000,000 less. So the seller-buyer gap hasn't changed. Our reality hasn't changed. Underwriting is as difficult, but you're paying $8 million less for the same net operating income. How could today be worse? And that's reality. Where my brother and all the people here are, is they're suffering because their investors are unhappy. Their investors have stopped receiving cash flow. Their investors have been subject to cash calls. Their investors read stuff on on the internet and watch stuff on YouTube, and none of it is complementary to commercial real estate. And so I'm looking at this as simply a problem of communication with investors. Every investor should know that investing today is a lot better than investing 24 months ago. The math is extraordinarily straightforward. So if you were an investor and you were willing to buy this property and make an investment of $100,000, and everybody and their mother was ready to invest 24 months ago, and those properties have now come down 25% in price without any decline in NOI, how could this possibly be a worse time? But what's really happened is investors are driven by how their portfolio has done in the last 24 months, as opposed to today's opportunity. So this is no different from 2008. In 2008, the last 2 years were all bad news. But wasn't 2008 an incredible time to buy real estate?
Yeah.
Right? But so people didn't buy back then. I was prevented for 2 years from going to family events from between 2008 and 2010, because all I would do is go there and say, this is the greatest time ever to buy real estate. And I thought I would infect all of the people in the family, so I was not invited. But by the end of 2010, I owned 15 properties, all cash flowing like mad. And then my family went out and bought another 50 of them for much higher prices, by the way.
Yeah.
My point is, investors, because they look backwards, and it's natural that they look backwards at what's happened in the last 2 years, are glum, they're demotivated. And it's the job of the syndication industry to tell them the truth about what is actually happening today. And I feel people here are not doing their job really well.
So, Neal, a year ago, you spoke to us and you said people are going to have to do cash calls. They've never had to do cash calls in their career. And so, there's a correct way to do it, and you got to look down the road. And you spelled it out so much more eloquently. But have you seen as much of that happening as maybe a lot of us thought, or has that been a little better as well?
Well, that's a very sad story because I made the horrible mistake of teaching a cash call boot camp exactly 1 year ago at this conference. And I did that because I felt that while the syndication industry knows how to underwrite, raise money, buy buildings, and rehab them, no one in our industry knows how to do cash calls. Simply because the entire industry was invented after the 2013 Jobs Act. So syndication basically came into being in 2014. There was a guy named Michael Anderson that both of you know that somehow managed to do it before that time, but he was a true pioneer. There were very, very few real sources back then. I was an investor with him. But as an industry, it's really only existed since 2014, right? And so how many people have had to do cash calls since 2014? You're living in the glory days of Rome. I mean, there's no cash calls. So when I go around asking all these people that have $2 billion portfolios, how many cash calls have you done? I haven't done one. Okay, can you explain to me how to do a cash call? I got horrible answers. And I'm like, we're going to screw ourselves over as an industry if we don't get better at this. So I volunteered to basically teach a cash call boot camp. It was about 45 minutes. And I happened to be somebody that has done a cash call back in 2014. And I learned a lot from that cash call. Learned things that I want to really unlearn. But it was very useful. And so I do this boot camp. And I come out of the room and people are following me. And since then, a week hasn't passed in the last year where one of my friends doesn't call me and says, hey, I know this other guy who doesn't know you, and he needs to do a cash call and talk with you about it. And now, because my friend is calling me, I have no choice but to talk to this guy. So for the last year, I have been an unpaid cash call consultant to the industry.
So if I'm summing up some of what we've talked about so far, the way to fix your portfolio problems potentially could be go buy more real estate right now while the getting's good, so to speak.
Isn't that what famous investors do? When famous investors say, I made a bet and the price went down, I'm going to give you a stock example, right? Warren Buffett says, I bought US Steel at $50 and I thought it was a great deal at $50 and now US Steel is at 40. Well, Warren Buffett doesn't cry about that. He buys more US Steel because if it was an awesome deal at 50, it's a slightly more awesome deal at 40. This is called dollar cost averaging. So I don't have any ability to figure out where the bottom in multifamily is. But I do know the following things. The price of multifamily has declined by 20%. Some markets might be 25. And this number doesn't come from me. It comes from Yardi Matrix. I also know that the price of multifamily is likely to continue declining in Q1, well, Q2 and Q3, and maybe beyond that. I don't think it's going to be much longer than that. So I know that I probably haven't hit the bottom yet. But since I don't have the ability to calculate the bottom, what I know is it's cheaper than it was. And as I continue buying, it'll probably get cheaper. So dollar cost averaging, which also can be described as the smile, is wait until things are cheaper and then buy, and buy. And across those assets, you will have hit the bottom at some point.
Yeah, that's huge. Do you think that a lot of this came from many people getting into the industry when it was so much of a trader's industry versus a long-term buy and hold mindset? Because that's basically what you're saying. If you're in this for the long haul, you don't care what, the value has gone down because you know that ultimately it's going up.
Yeah, and I have to say this, that you do podcasts, you interview a lot of people, and I think you can tell when you interview people that some of them have a longer horizon and mindset than others. And I'm actually happy because I think that the people that had a short-term mindset, they're not going to be syndicators in 18 months. And the industry will return to the Michael Andersons of the world that never really cared about an asset's value at any particular time or point of time. He's a mentor of mine, and what he cared about is how much money can this asset make my investors in 5 years or 6? And if it can't make it in 5 or 6, can it make them that same amount of money in 7 years? Because not every asset is going to be a home run, right? Mike says some are going to be singles and some are going to be doubles. And Mike only wanted to work with investors that understand that. And I only want to work with investors that understand that. And so I work very hard to make sure that that's the kind of investor I have, right? So the kind of investor that gravitates to me is very sort of nerdy, geeky, math-driven sort of people. So I have a large database of doctors and scientists and programmers, lawyers. These people understand that there's nothing magical in what we do. We're people that understand that there's a supply-demand gap in the market and are doing our best to live within that gap. And the bottom line is, not too many people in syndication over the last 4 years were trying to gather audiences that understood that believed that. They were trying to gather people that were like, I can't lose. Multifamily only ever goes up. Multifamily is magical. Rents will only ever go up and can never go down. None of these is true. Multifamily is an asset class. It's a privileged asset class, unlike hotels or industrial, and we can talk about why it's privileged, but it's not magical. And so I think the people that are going to do really well are the people that basically go back to their investors and say, hey, it turns out we were not magical after all, and this is what we're doing to move forward. And they'll keep the investors that understand that, and they'll get rid of the investors that don't, and that will be great for the industry.
Yes, absolutely.
I think those investors should go back to trading stocks.
Makes so much sense. Neal, what kind of opportunities are you bringing your investors nowadays?
So for the moment, I'm fairly quiet, and the reason for that is, and I'm going to say this with apologies to all of the other syndicators. Please don't beat me as soon as I get off of stage. I am unable to make anything that is not an assumption work. I believe that in Excel, any property in the world can be made to work at 15 IRR. But my belief is, with some possible odd exceptions, the only thing that works today is an assumption, and my ability to find assumable loans that are high LTV is extremely limited. And so I'm fairly quiet. So I have a property that we were able to fund with absolutely no problems at all. It was an assumable loan. It was fixed for 5 years, so I didn't have to deal with any of the loan issues. And most importantly, it was so high LTV that I didn't have to get a supplementary loan. I just assumed that loan and bought the property. And I didn't put a lot of equity in. $30 million property, less than $10 million in equity. That's what I think works today. And unfortunately, I can't find more properties like that. So I'm quiet. I'm also building towards my life's mission. I don't love syndication. I don't love value add properties. I think it's a way for me to make money and my investors to make money. I love adding stock to the United States. I love doing something that truly makes a difference, because when I buy a value add property and I add value to it, if it was 200 units at the beginning, when I'm done, it's still only 200 units. I haven't added any stock. So my life's mission is to add stock to the United States, to finish with more units than there were, because I think that's what this country needs. And so at the same time that I'm continuing to move along on the value add path, I'm working on my mission, and my mission is to build 10,000 rental townhomes in the United States. I've come to the astonishing discovery that Americans don't want to live in apartments. They actually want to live in homes. And if they can't afford homes, can't buy homes, they want to live in townhomes. And so I continue to move along my life mission, and actually continuously recruit people to that vision. It'll cost $2.4 billion to build 10,000 rental townhomes. So I'm moving along on that path, but there's no open opportunities for investors right now.
And if somebody wants to know more about that mission of yours and potentially be a part of it in the future, what's the best way for them to get a hold of you?
It's straightforward. It's a mission. It's a profit with a purpose mission. So it's not a non-profit. I find non-profits do not scale. I want to build 10,000, not 10. If I was building 10, it would be a non-profit. If I'm building 10,000, that's some investor or investors have to make money. So I have to find a way to make it profitable. So there's a website, it's called mission10k.com. Go to mission10k.com. I don't hide anything. My entire strategy is mentioned on this page. There's videos, there's pictures. It explains everything. It explains all the cities that qualify using data science for Mission 10K. Because of 1,016 cities in the United States, only 12 work for Mission 10K. They're mentioned on the site. Feel free to go out there and do what I'm doing. Feel free to copy what I'm doing. I will be shameless, and if you end up building 100 townhomes by copying me, I will include your 100 townhomes in my 10,000 because that's my mission. So you've helped me, so feel free to copy mission10k.com, and you can go there. You can sign up as an investor, you can sign up as a partner, you can sign up as an equity partner, however you wish. As I said, nothing available right now. Big visions take big time to bake, and I'm very patient. So one day you'll hear from us about Mission 10K. I don't know when.
All right. Neal, you have always been such a great friend of PREIShare. We're grateful for all the introductions that you've made for us and for what you're doing for the marketplace.
Thank you so much for having me.